Welcome back, everyone, for another deep dive. This time we're going to be taking a closer look at Rajev Thakkar's latest investment newsletter.
Oh, yeah, I saw that one.
He's the Chief Investment Officer of PPMF, and his insights are always
Yeah.
really thought-provoking.
He always has a unique perspective, and he doesn't shy away from challenging conventional wisdom.
Exactly, and we're lucky to have an expert here with us today who can really unpack
Yeah.
Thakkar's wisdom and connect it back to the larger world of investing.
Well, I think one of the things that makes Thakkar's newsletter so refreshing is that he goes beyond just the market updates.
Right.
You know, the typical stuff you see. He delves into history, he talks about investor psychology, he even draws some interesting parallels with cricket.
Yeah, speaking of cricket, he uses this brilliant analogy to address what he calls the buy the dip illusion. He compares long-term investing to a test match,
Right.
not a T20. Implying that sustainable wealth, it's built through patience and strategy, not just these quick hits.
It's a great analogy because it really highlights the difference between short-term speculation and long-term investing. A test match requires endurance, discipline, and a deep understanding of the game. You can't just swing for the fences every time.
Exactly. But this buy the dip mentality,
Hmm.
it's been tempting lately, hasn't it?
Oh, absolutely. Especially when you look at the Nifty's performance over the past few years. It's seen positive returns every year since 2019, starting at 10,830 and reaching 23,883 by November 12th of this year.
Wow.
It's a pretty remarkable run.
Yeah, and it kind of creates this narrative.
Yeah.
There's this guaranteed upward trajectory.
Yeah, and that's where the danger lies. It's easy to get caught up in recent trends and extrapolate them into the future. But history has shown us time and time again that markets are cyclical. What goes up must eventually come down.
Right, Thakkar even talks about this. He's expressed concern about the rise of speculation, especially among, well, younger investors.
It's understandable, right? They've grown up in a world where technology has made investing more accessible than ever before.
And they've witnessed the incredible growth of the tech sector firsthand.
Exactly. But while it's great that they're embracing equities, their attraction to things like day trading and IPO flipping is a bit concerning. It's almost as if they're treating the stock market like a casino.
Yeah, I mean, it is concerning when you consider the data, right? Thakkar cites SEBI data that reveals that many individuals engaging in day trading are actually losing, on average, 40% of their capital.
It's a sobering statistic, and it underscores the importance of education and a disciplined approach to investing. Thakkar really stresses this in his newsletter, the need to have a well-defined financial plan and not just chase quick riches.
Right, and it's something that, we've talked about a lot on the show.
Right.
Building a solid financial foundation isn't about, timing the market or chasing the latest hype.
It's about understanding your goals, managing risk, and making informed decisions. It's about building a portfolio that can weather the inevitable storms that come with investing.
Yeah, it's about having that long-term vision, which actually brings us to another point in the newsletter I wanted to touch on, sectoral funds.
Oh, yeah.
Thakkar uses this great example from the 1990s, the Indian aviation and telecom booms, to illustrate the pitfalls of chasing hot sectors. It makes you think, are we seeing any parallels today?
Well, we're definitely seeing a surge in thematic funds, right? Focusing on sectors like electric vehicles or artificial intelligence. The narratives are compelling.
Right.
But as Thakkar points out, it's easy to get caught up in the hype and overlook the risks.
Especially when everyone is jumping on the bandwagon.
Exactly. And he even quotes Benjamin Graham, the father of value investing, who famously said that obvious prospects for phenomenal growth in a business do not translate into obvious profits for investors.
I like that.
Yeah, it's a reminder that even if a sector seems poised for explosive growth, it doesn't guarantee investment success.
Right, and often even the experts can't predict which companies within that sector are going to, truly thrive.
Absolutely, and that's why diversification is so important. Trying to time the market or pick winning sectors consistently, it's really a fool's errand. Sticking to broad-based, diversified equity funds, that's generally a more prudent approach for most investors.
Makes sense. So let's shift gears a bit. I want to talk about what Thakkar calls the small and mid-cap myth.
Okay.
He presents AMFI data showing that assets under management in small and mid-cap funds have actually surpassed those in large-cap funds. As of October 31st, the AUM for small and mid-cap funds combined was a whopping 6,003,694 crore rupees, exceeding the 3,059,461 crore rupees in large-cap funds.
I mean, that's significant.
It is.
Yeah.
It makes you wonder, is the balance shifting? are we seeing a fundamental change in the market?
It's a question a lot of people are asking. But I appreciate that Thakkar doesn't jump to conclusions. He
Mhm.
actually challenges this assumption that smaller companies are always going to outperform larger ones.
Right.
While they may have higher growth potential, they also come with greater volatility.
And that's where Thakkar's test match analogy comes back into play, right? You're not looking for explosive short-term gains. You're in it for the long haul.
Exactly. It's about understanding the inherent risks and balancing them within a broader portfolio strategy.
Right. And I think it's important to remember that the bulk of corporate profits in India, around 75% on average, still comes from those top 100 large-cap companies.
Right. They might not be as flashy
Right.
or as exciting, but they form the bedrock of the market.
Exactly. They're the foundation. So while small and mid-caps can certainly be part of a diversified portfolio,
Yeah.
it's crucial to be realistic about their role. They shouldn't be viewed as this guaranteed path to outsized returns.
Agreed. It's about finding that balance.
Now, Thakkar then delves into this concept of managing expectations in a changing market.
Okay.
He observes that investor expectations, especially for new investors coming in, are sometimes a little disconnected from the realities of corporate profit growth, which is influenced by all sorts of factors like globalization, equity issuance. It's not always a straight line upwards.
It's complex. And what I find interesting is that Thakkar kind of subtly hints at this by highlighting India's nominal GDP growth, which is projected to be around 11% to 12%.
Oh, okay.
It suggests that maybe investors are expecting unrealistic returns from equities, given those growth projections. So it begs the question, are we setting ourselves up for disappointment? Are we being a little too optimistic?
It's a good question, and one that we'll have to explore further,
Yeah, it's a question worth pondering for sure.
and it makes his next warning all the more relevant.
Uh,
Valuation creep.
mm.
He's observed that valuations have steadily climbed over the past, couple of decades,
Right.
and we're seeing triple-digit PE ratios that barely even raise an eyebrow these days.
Yeah, it's become almost commonplace.
And even loss-making companies are getting bid up based on, narratives.
Rather than fundamentals.
The stories are captivating.
It does make you wonder how sustainable is all of this, especially when you consider
Yeah.
the changing interest rate environment, right? Absolutely. Thakkar reminds us that the days of near-zero interest rates are over.
Right.
I mean, one-year bank CD rates for top quality banks in India are now around 7.6% per annum.
That's significant.
It is. It's a significant shift from what we've seen in recent years.
So how does this impact our view on equity valuations?
Well, think about it this way. At a price-to-earnings ratio of 50 years, a company is essentially earning 2% on your purchase price.
Okay.
At a PE of 100, it's just 1%.
Right.
Those returns start to look a lot less attractive when you compare them to the relatively risk-free return you could get from a bank CD.
Right. You're getting almost 8%.
Exactly. So it really makes you think twice about where you want to put your money.
And Thakkar actually uses a really compelling example from Infosys to illustrate this point.
Oh, yeah. What was that?
Between 2000 and 2010, Infosys profits grew phenomenally.
Right. They were a market darling.
From around 265 crore rupees to over 6,219 crore rupees.
Oh, that's impressive.
But investors who bought the stock at those very high valuations during that period, they actually saw losses
Really?
in the first 5 to 6 years.
So even though the company was growing?
Yeah, even though the company was doing well, the stock price didn't reflect that growth initially.
Because they overpaid for it.
Exactly. And even after holding the stock for a full decade, their returns were comparable to what they could have earned from, fixed income instruments.
Interesting.
So it really highlights the importance of valuations.
Absolutely. It's not just about growth. It's about buying that growth at a reasonable price.
Right. So given all of this, how does Thakkar approach these challenges at PPMF?
Well, he brings back the cricket analogy, advocating for that test match approach to investing. Remember, patience and discipline.
Right. Slow and steady.
And a key part of that strategy is the role of cash.
Okay. Now that's interesting.
Right. You hear a lot of people say stay fully invested, but Thakkar is saying no, hold some cash.
Why is that?
It gives them the flexibility to seize opportunities when valuations become attractive
Okay.
without feeling pressured to be fully invested at all times.
So they're not trying to, time the market perfectly.
No, they're not trying to predict every little up and down. They're just waiting for those really good opportunities to come along.
When the price is right.
Exactly. Like a seasoned batsman waiting for that perfect ball to hit.
So they're not afraid to sit on the sidelines and wait.
No, they're patient. They know that good opportunities will come along eventually.
It's a powerful reminder, I think, in today's market where everyone's, rushing to get in on the action.
Absolutely. Sometimes the best action is inaction.
I like that. Sometimes the best action is inaction. So as we look at the current market landscape, with these high valuations, with these changing interest rate dynamics, what are some key insights our listeners can take away from Thakkar's approach? What really stands out to you from all this?
I think one of the biggest takeaways is that investing is not a get-rich-quick scheme.
Right.
It's a long game.
It's a marathon,
It is a marathon, yeah.
not a sprint.
Exactly. And I think Thakkar does a great job of reminding us that,
He really does.
yeah,
It's about patience
patience and discipline.
and not getting swayed by every little blip in the market.
You can't react to every headline.
No.
You have to have a plan and stick to it.
Right. And his emphasis on valuations,
Oh, yeah.
I think that's particularly relevant right now
Especially now.
when the market seems to be, defying gravity a little bit.
There's this feeling that it can only go up,
Right.
but we can't ignore the fundamentals.
No, we can't.
As the Infosys example shows, high growth doesn't always mean high returns for investors.
Especially if you overpay for that growth.
Exactly.
So as we navigate this current market landscape with these high valuations, with these changing interest rates, what advice would you give our listeners?
That's a good question. I would say first and foremost, know your goals. What are you trying to achieve with your investments? Are you saving for retirement? Are you saving for a down payment on a house? Once you know your goals, you can start to develop a strategy that aligns with those goals and your risk tolerance.
Right. It's so easy to get caught up in the hype and the excitement of the market and kind of lose sight of why you're investing in the first place.
Absolutely. It happens all the time.
Yeah.
So yeah, define your goals, do your research, and don't be afraid to seek out advice from a qualified financial advisor if you need it.
Those are all great points.
And remember, investing is a marathon, not a sprint.
That Thakkar analogy really sticks with you, doesn't
Oh,
it?
it does. It's so true, though.
It is. It's about patience, strategy, and, playing that long game.
And having a cash reserve can be a valuable part of that strategy, too.
Right.
Yeah.
It gives you that flexibility to take advantage of opportunities when they arise without feeling like you have to be all in all the time.
Yeah, you don't have to swing at every pitch.
Exactly.
Wait for your pitch.
Wait for your pitch. So before we wrap up, here's a question for our listeners to ponder. Given all that we've discussed today, the allure of the buy the dip mentality, the risks of speculation, the importance of valuations, and the power of patience, how will you approach your investment decisions going forward?
It's something to really think about.
It is.
And if anyone's looking for further reading on this topic, I highly recommend Benjamin Graham's classic, The Intelligent Investor.
Oh, that's a great book, a timeless classic.
It really is. It's still so relevant today.
Absolutely. And remember, investing is a journey, not a destination.
That's a good way to put it.
Yeah, it's about continuous learning. It's about adapting to those changing market conditions and just making informed decisions that really align with your financial goals and your risk tolerance.
It's a process.
Thanks for joining us on this deep dive.
Yeah,